Good evening. Welcome to the weekly market wrap up. The Fed is taking aggressive interest rate hikes to tackle inflation. This is a move that has not been since early 1990s. The Federal Reserve hiked its rate on the 27th of July by 75 bips, following a 50 and a 75 bip hike taken earlier this year. This interest rate hike was widely expected and is being carried out as part of the monetary tightening policy following the record high inflation recorded in the US. The US reported a 40-year high inflation in June 2022 at around 9%. The global financial conditions are expected to remain tight in the coming months and could result in capital outflow from emerging countries like India. This could also keep Rupee to be volatile, which will in turn put inflationary pressures of our own in India due to high cost of goods and services. The current Rupee depreciation has already caused a dual deficit problem of high fiscal and current account deficit in India. High commodity prices in the first half of 2022 have deteriorated the foreign currency situation of the country, as India is a major importer of several commodities like crude oil, palm oil, etc. The latest hike in the Fed rate will further improve US Treasury yields, causing more money to outflow from India and making rupee go more weak. The RBI could also announce a 50 to 60 bips interest rate hike to attract foreign inflow, especially in this time where we have a record current account deficit. We believe the Indian markets have already priced in a 75 bips hike, and the impact of any further announcement during the MPC next week could have minimal effect on the market. The interest rate sensitive stocks may see margin pressures following the MPC hike that is likely to be announced next week. Coming towards the equity side, Maruti and Tata Motors both announced their Q1 FY23 results during the week. While the companies reported sequential improvement in volumes, the margins still remain under pressure highly due to the increased commodity prices. We expect most OEMs to witness higher input cost pressure sequentially given the lag impact of commodity prices. However, given the sharp fall in few commodity prices in the quarter, the impact is likely to be much less than viewed earlier, as few OEMs have managed to renegotiate the pricing contracts with their vendors in Q1. The key factors to watch out during the further Q1 auto calls would be the industry demand outlook for both rural and urban, and if there have been any visible impact of the current inflationary pressures. The second thing to look out would be the normalcy in the supply constraints and how the chip supply situation has improved. The third thing to look out would be when would the benefit of these softening input costs will start reflecting in the financials of the OEMs. And the last thing that we would like to keep an eye on would be the geopolitical commentary and how the rising operational costs in Europe can affect the companies. These will be the key pointers for us to look out during the upcoming auto result. Thank you.